So what we're going to talk about here tonight or this evening is how to profit from earnings season right now. And so let's get started. Make sure everything's going good here. Okay, so first off, we'll talk about a 5-step plan that I use for earnings season success. And it goes through how to find volatility and use it to your advantage. A screening process I use to find the most probable winners. Pre-earnings price target analysis that I do. My favorite trading tools for earnings, and my favorite non-directional earnings strategy. So the following webinar is purely for educational purposes. Any stocks, options, futures mentioned does not constitute advice and should not be construed as a recommendation. Again, I've been an active trader for over 30 years and previous executive vice president for one of the largest oil trading companies in the world, so it was a really great opportunity for me, a fantastic place for me to learn, and trading is just kind of a continuous journey of learning. We were one of the first groups to also trade over-the-counter options on crude, and that's where I got my start trading options back in the mid-'80s. It was about 1987, I believe. Went on to launch the institutional over-the-counter crude oil option brokerage desk for PVM Oil out of London, which is the largest privately owned oil brokerage company in the world, and that was another really great learning experience for me, for option side of things. So a lot of trading background, a lot of option background, and what we'll talk about, specifically here today is earnings. So earnings just recently kicked off, and it's a really exciting time of the season for trading. And with earnings season, stocks tend to get some really great spikes up or down, which really allows that smart trader to get prepared and capitalize on these types of uncertainty that earnings present. And it's coming 4 times a year, so why not get ready? And I actually really get excited about it. If you're an option trader, what beats high volatility and knowing how to trade through it using option spreads? So ask yourself this. What if you could add a new stream now of income? Would that change your life? And if the answer is yes, then you have a plan to achieve this goal. Now, developing a new income stream can take years to achieve, considering the amount of education and work that's usually required. But what if you could learn in only a few hours how to add a new stream of income by creating option spreads to capitalize on stocks reporting earnings? Have you ever been confused by the weird movements in a stock price during its earnings announcement? Have you noticed how earnings can be just horrendous and the stock goes straight up, or earnings can be off the chart fantastic and it goes down? Well, this is what I call the earnings confusion. And what's up with all this? Now, when a company has an earnings conference scheduled, many times there's speculation not only into the accuracy of its projected earnings that it'll announce, but also other factors that can surround an earnings release. A lot of times companies will talk about layoffs, or they might talk about a stock split, or announce a stock split, which is what we saw about 3 cycles ago with Apple. It was during their earnings announcement and conference call that they said that they were going to do a 7-for-1 stock split, and the stock went through the roof. So you have a lot of uncertainty and a lot of surprises that can pop up from an earnings announcement. So it's this uncertainty of all this that typically causes the volatility in the shares themselves, and the temporary or diamond in the rough is actually that temporary parabolic increase in the exchange listed options on the underlying shares. So here's what happens. Now, traders tend to stay on the sidelines going into the days leading up to the earnings conference. Call buyers will swap out shares of stock for long call options so they can participate in the rise should the share move higher, and limit the potential loss should the shares trade lower. So a lot of hedging going on and a lot of swapping out of stock shares into options. So this creates a lot of buy demand coming in at a kind of a very small window of time. And this causes those call options to trade in many cases at drastically expanded volatility levels. Now, additionally, then you have the put buyers that come in and they force the option prices higher as well when they're trying to buy puts to protect their long positions from any major downside movement. So the combination of all these buyers for the put side and the call buy side increases that implied volatility, which increases the premiums on options. So as an individual trader, you can take advantage of all this uncertainty and volatility in order to capture profits, no matter what those crazy earning reactions are, if you just use the right setups. So step one is to find out how to identify and qualify a particular stock by looking at its past performance heading into earnings. That's the key to successful trading, period, is just looking at setups and in earnings. It's really really important to look at past performance and see if there's any kind of consistency or trends. You want to find those stocks that have their earnings release closest to a weekly option expiration or the week of its monthly option expiration. So I found just through experience that it's better to trade the short duration type options, because what happens a lot of times, you'll get a big spike and then if you don't let me get my drawing pen out here, one second. So what I've noticed that happens is you'll have a stock, let's say, take for instance Netflix today. It closed at, let's say, $350, and then after earnings are announced, it's spiked up about close to 20%. So it has a huge move to the upside. Now you'll probably get some fall through tomorrow. Maybe it'll come back off. But what I've found is that it's better to have short duration options to try to take advantage of these big spikes up or down that can last 2 to 3 days. If it lasts longer than 2 to 3 days, usually you're going to get that reversion to the mean. So that's the tendency, is to use the short duration options for an earnings trade into its release. So that's one thing that I always do, is use the weeklies or an option that is going to be in the week of expiration. If it's in a monthly. And then step two is I look back and I back test to see what volatility has done previously to a stock as it moves closer to its earnings release and after. So smart traders, they're going to look for the kind of a dramatic increases in front and second month volatility, and you're looking at this a few days prior to earnings, and this is known as the increase in the volatility skew of an option. Now, as a stock's front month volatility, it may normally be around 30 to 40%, but when you come into earnings a couple days before or that day of an earnings release, that volatility can easily move to extremes, and this is what you're looking to take advantage of. So for example, here's Netflix, and this was today right at the close, and it's announcing today. So you can see it's got 3 days to expiration, and look at the implied volatility. I mean, it's 142.89%. So you can see that the average is more like about 50. So this is 2.5, about almost 2.5 times the normal volatility, and that's because of earnings and the uncertainty that brings. Here's another example, SanDisk, 72. This was the last earnings cycle, or back in July, 72%. You can see its normal volatility is around 35, 38. And the other thing that this really helps you to do is that you can have several different types of trades going into earnings. I call the first type of trade setup is the pre-earnings trade. You can see here on SanDisk back in July of 2014, it had a nice trend to the upside as it was going into its earnings period right there. Now the other thing you'll notice is the implied volatility, this blue line, was going up. So we talked about that a little earlier. You get a push on implied volatility. So you get the double benefit of price going up, which is increasing that delta of the option. That increases the premium of the option. Plus, you've got the implied volatility going up because you're getting the earnings. So you have a double push on the premiums of the option. So if you can catch a good trend into earnings to the upside or downside, you can get really nice profits, because you get also the boost from that trend of the implied volatility moving higher. And then you can see after the earnings were released, got crushed on implied volatility. So you want to keep these trades separate. So cycle one, this kind of trade up, get out at earnings, before the earnings are released, and then go on to the next trade. Now here's an opposite example. Here's SanDisk to the downside. This is back in October. So nice trend to the downside. One second. I've got my lab puppy, and he's sees something he doesn't like. Just one second. So anyway, what you're seeing here is SanDisk moving to the downside. So you could have bought puts and had a nice move down, and also those puts are going to increase in value because they increase here in the implied volatility. And then you want to be out on earnings release because then you can see it goes directly up. So here's a trade into earnings, and then you can do a trade at earnings announcement and a trend trade after. So there are three basic kind of trades that you can capture, but you need to look at history to see what the consistency is of these various stocks that you're trading. So this is what makes the stocks a potentially great trading candidate. Normally the volatility can double, and in some cases it can be even more extreme than that. And this is what we're looking for, is that extreme volatility to take advantage of. So it's for this reason it is essential to put together a watch list. Yeah, thanks. I think I might have to throw the dog more than a bone. He's a 3.5-month little lab, and I've got him downstairs, but unfortunately his bark is louder than the sound barrier. So apologies there. And it's for this reason it's essential to have a watch list of stocks that you want to monitor closely due to the fact that they may not all present an equal opportunity for an earnings trade. So you want to remember the goal is to take advantage of the temporary rise in volatility going into an earnings release. So a stock's option, it needs volatility, and without volatility you have no price movement, and without price movement you pretty much have no chance to turn a profitable trade. So then how can you find the volatility and then turn that to your advantage? So it's for this reason, volatility, that I put together a process I use for building a high probability trading list of stocks to trade into their earnings release. And I'm looking exclusively for high volatility stocks with weekly options. Now it's this screen that I use, it will track the following data to compile my trading list. So I'm going to look again at the stock's volatility. The stock, I want it to trade on average of 1 million shares or more to give it liquidity. And then I'm going to track closely the straddle cost for volatility as it goes into the earnings date, and the date that it announces its earnings. So I also then look for the pre-earnings implied volatility, and I use this to forecast the expected implied move of the stock after its earnings announcement. I then also look at the prior post-earnings moves from 1 day after an earnings release all the way out to 21 days, and I'm looking for some consistent pattern to see if it trends in the direction of its earnings release after the earnings are announced. So all this historical statistics from past earnings can really help you to define trends that you can trade. So again, you have kind of 3 different type of trade setups that you can have going into earnings. You've got one that build up and potential trend into earnings, the release. You want to be out of that trade before the release. 2, you have the actual earnings release trade. So you want to have that trade on the day that the earnings are announced and take advantage of either spike up or spike down or a collapse in implied volatility. And then 3, you can look for those stocks that tend to trade and trend in the direction of their earnings release. So it gives you some really great opportunities during an earnings season. So one major element to trading an earnings release successfully is knowing the stock's implied volatility or its expected implied move, and then knowing how to use this information to trade the setup. So this number is expressed as a percentage of the stock price, and it's indicating a 1 standard deviation move over the course of that stock option cycle. And it's this statistical forecast of probability that is the foundation of an earnings trade. So it's this information that's the foundation of a lot of your different option type strategies, is the implied move and using that to establish target prices. So this is an example to show you what that implied move looks like and how it relates to targets. The implied move is what the marketplace theoretically expects the price of a stock to do based on the stock's at-the-money option price. And this is an example of Google that we'll use here. And what the information, the input into your model, your option pricing model will be days to expiration. So in this particular example, we're going to say 3 days. The expected implied move, the market makers will make this is a plus or minus 4%, which is based on the at-the-money price of Google, $500. This is where the pricing starts, is at the money. This is where all the supply-demand starts. And on Google, in this example, it's at $500. Now, this is a distribution curve, a bell curve that shows you how pricing or data is distributed. And so if you look here at the $500 at-the-money cost of Google, the market makers are telling you that it's going to potentially go up 4% or down 4% in 3 days till expiration. So that would send the price down to $480 or up to $520. So it's this band between here, that's that one standard deviation move, and that's a 68.2% probability, just a theoretical probability based on statistics of distribution. So with this kind of information, then you can set up price targets to use. So with an earnings trade, you're going to either have price exceed the implied move, either up or down, or it's going to, because of volatility collapse, it's going to stay inside the implied targets or the implied volatility. So with these numbers here, this helps you set the implied move. So it's a very critical number, and it's a target price number that I use for all my trading. So it's this implied move, and it's what the marketplace expects that stock to do in theory, and this is the best way to forecast that move. Now, although it's not 100% accurate, implied volatility and using the implied move of an option is super useful, and it's a free tool, which also makes it great, and it's a free tool that you can use for forecasting a stock's price movement into its expiration. And again, it is what the marketplace expects the stock to do in theory. But this stuff is amazing, how it can really help you as far as your trading there. Now, step 3 is the pre-earnings target price analysis. And this is probably the most important part for earnings trades or trades in general, is your homework, going in to see what things will do. Now with this is a kind of a typical worksheet that I'll put together, and this is Netflix. This was today. This should be January. I don't know why it says the 15th. So this date's wrong, but this should be January today, the 20th. So Netflix today, after the close, was announcing its earnings. So what I do for every stock that I'm going to trade into an earnings release using a non-directional option strategy, I will go through this workup. So you can see here all the information I've got in here. So here's today, the 20th. Netflix was trading around $345 towards the close. The market makers, based on the implied move, were giving you plus or minus 12% up or down implied move based on the weekly option for expiration in 3 days on Friday. So then what I do is I look back at prior history. So I go back in October. I can see the October implied move was 6.51% up or down. July, they had 8.05 up or down. April, back in 2014, 11% up or down. 9%, 12%, 13%, 14%. These are all implied move statistics that are given by the market makers that you can find on your option platform. So if I look at all this and average it, I can see that the average implied move over 7 cycles has been around 10.93, or let's say 11%. Today they're looking for a 12% implied move. Now then I come over here and I look at expiration. On expiration, what did it actually do? Well, last earnings season, it had a move and it closed down. It was down 20% from the date of its release. So 448.59 was the closing price on the day that earnings were released, and at the end of the week, at expiration, price was down 20%. The cycle before that, price was down 5.87. Cycle before that, it was down only 1.26, but 5 days later, it was down again, and then 15%, 6.5. So what you see here is that the average implied move on expiration is over 11%. So the tendency for Netflix is to exceed its implied move. So that tells you what kind of trade that you can put together. So what I'm looking at is maybe placing a trade that's plus or minus 5% from that closing price. So I'll show you how that works in a minute. So this is the worksheet I put together to determine what kind of strategy I want to use. So step 4 is that the power of weekly options. Now, weeklies are still one of the most lucrative trading opportunities that exist today, and that's due to their defined risk, low cost that they provide because they have less time value built into the option price, and the highly levered returns they can offer. So they're excellent for these type of earnings strategies. Now, I use the weeklies for all my earnings trades, and that is done to take advantage of those two key elements, time value and implied volatility. And it's by combining these elements, when used correctly, it creates a winning, low-cost, defined risk kind of trading formula that will generate some really unmatched high returns in a very short period of time. So if you know which weekly option strategies to use for an earnings trade, how to construct the trade, and when to execute the trade, then weeklies can produce some exceptional, really fast profits due to the incredible leverage they provide, making them the perfect vehicle for an earnings trade. So how's this done? Well, what I'll do is I have about 4 different strategies I look at for an earnings release type trade, and then I do what I call the comparative option strategy analysis. So when constructing the earnings strategy, I'm going to compare the risk to reward or the return on capital at risk between the various strategies that I'm going to use, and then compare what gives me the best risk reward for my trading goals. And there are going to be times too when you can have more than one strategy to be employed. Now, everybody here today, we're all different as far as our capital account, how much we can trade, so we'll have different risk parameters, and that's what you have to kind of look at and compare in order to find the strategy that works best for you out of the ones that, in this example, that I use. So here's like from the past 3 earnings seasons, this is one particular non-directional option strategy that I like to use, and the trade returns are pretty consistent here, and I'll show you this trade set up here in a second. But you can see that the returns are about 20, 25%, and you can see how the short duration of these trades are. 1 day, 3, 4 days at the most, because these are using weekly options, and that's what I like to use for those specific reasons I kind of mentioned earlier. So these are over the past 3 cycles, and you can see the returns are very consistent. So the way I set these trades up and structure them, they're based on probabilities and based on looking at historic occurrences, and they're high probability type trade setups. But the returns, are 20%. They're not going to be 100%, 500. They're not going to be these huge blowout, home run hits. They're just singles, but they're real consistent. Now, step 5 then is, what is this strategy and how does it work? Well, there are several methods to capture profits from extreme price volatility that surround every earnings season, and each method works best based on certain circumstances. I personally don't like to spend a whole lot of time having to watch a trade all day long. So one method that I like to use and I teach most often involves almost no work once the trade is placed. Now basically it comes down to 4 steps. You buy 2 options and you sell 2 options. So it may sound like a lot of steps or not that many if you're an experienced option trader, but once you understand this method, you just use the same method over and over each season, and it's really pretty simple. So this is how it works, and this is on a trade on Amazon, an example. And step 1 is just you buy Amazon 345 call, and here you paid $660. You sold the Amazon 350 call, collected $495. Your net cost before commission is $165 on step 1 or leg 1. Step 2 is you buy the Amazon 325 puts, you pay $620, you sell the 320 put, you collect $455, your net cost here is $165, or your gross cost, and then your spread, it's the $500 spread, 350 minus 345, 500, less your total cost, which is your capital at risk, and that cost was $330, adding those 2 legs together. Now the difference is your potential net profit, gross profit before commission of $170 per option contract. So this trade, in this example, made $170 per contract before commissions. It's a high probability trade setup based on the way I structured it and selected it. And the maximum potential loss was your capital at risk of $330 per option contract. So this trade, it was placed, and it was only there for one day, and boom, $170 later. So if you had $1,650 to invest, you could have bought 5 contracts, $170 profit per contract times 5, you would have made $850 total profit. And that, based on your capital at risk of $1,650, was a 51.5% return. And it took, one day to do that, and it took about a half an hour to put the trade on. So once it was on, you just let it go. Now, bottom line, this strategy is called the Iron Condor, and it's a non-directional option strategy, and it's ideal for trading an earnings release. Now, it can be used to capture those explosive price moves that exceed the 1 standard deviation implied move the market makers are expecting, or it can be structured to capture the volatility collapse that happens after an earnings release, or possibly both. So will every trade be a winner? No, but we always wish we could have every trade a winner, but that's not the case. But what I'm looking for is to find those high probability trades, and I do that in a certain way that I construct it in selection of the specific stocks I'm going to trade into an earnings. So, with a high probability type of methodology or system, you can have very high percentages of winners, and it all comes down to a very selective and systematic selection process. So here again was Netflix. I showed you that earlier. Its implied move today was showing a 12% up or down. The average implied move is about 10.93. Now, the way I set this trade up was to do an Iron Condor based on a plus or minus 5% move. And based on 5% move, you can see here on the price percent change 3 days at expiration, there was only one time that it had a move of less than 5%. So this is an 86% probability type trade setup. And those are the type trades I look for. Now here's Netflix today. Here's the trade setup, 360, 362.5 long call up spread, 330, 327.5 put spread. And this was based on a 5% move to the upside or downside. And you can see here today after earnings announcement on Netflix, it's up to $400. So this trade, unless something bizarre happens, it will be a total 100% profit trade, and that will make Netflix, based on that, it will be 7 out of 8 times that particular trade strategies work. So that's an 88% probability type trade setup, which is not too shabby. So what I wanted to show everybody here today was kind of another way you can look at trading earnings, and how you can take advantage of it, not have to sit out during all this excitement and volatility during an earnings season. So I just would like to say, first off, thanks again for having me here today and letting me share some of my knowledge and experience on trading and options, and hopefully this will be stuff that you can look to use in the future to help your own trading. Now, I know a lot of you here, or none of you here, know me, so I wanted to share a couple of emails just from some of my past clients and members, just to kind of show you what I offer and what I've done here with these type of courses to my members and clients. So take a couple minutes there and just read through if you can. So, it's very rewarding when I can get kind of feedback like this and help my members, and so I just kind of wanted to share that with you now. Now, the next thing I'd like to talk about is how you can learn more on using weekly option strategies for earnings trades, and some simple things you can start doing right now to profit from this earnings season, which just really kicked off today with the really good stuff like Netflix. So what I'd like to offer everybody here, and then we'll get into all your questions, is this is a course that I've done. It's a recorded course on earnings season. It's a 3-hour recorded course in 30-minute modules, and it comes with a 225-page course training manual, very detailed, with about 32 trade examples on these earning type trades. Now, for anybody that signs up here today, the first 30 that sign up here today, you're going to get 2 really nice bonuses as well. So here's the link. So just use powercycletrading.com/new. Put that in your browser, and this course is $97. And it's a very step-by-step thorough course on using non-directional option strategies for earning release type trades. So what you're going to also get is my list of 30 best stocks with high volatility with high price movement to trade for earnings release, and then you're going to get also 2 follow-up accountability support Q&As. So what I've done for you is I'm going to save you a lot of research time and give you my earnings watch list of the best stocks to profit from during an earnings season. It comes on a spreadsheet that shows you the earnings dates. This is basically kind of what it looks like. It'll give you the earnings dates. It'll give you, the average volume, when the earnings are, after close, before the close, the next day, and it's going to show you what it did the last 4 cycles. Was it up 20%? Up 5.8, 1.26, shows you all this statistical information. So it's a list of over 30 stocks that I've scanned for to give me this kind of greater than 4% type price movement. So that's something you get, and then you're going to get the first 30. You'll also get 2 accountability and support coaching Q&A calls. The first one we've done, it was a 90-minute recorded session that I've recorded, and it's just 90 minutes of using this short Iron Condor strategy that I just showed you. Using a trading example, taking you through how to use the implied volatility and all that, and then we'll have a second Q&A which will be live in about 3 weeks. So I like to keep these groups small, so the first 30 that sign up here today, you'll receive that. Now the other thing too is if this doesn't work for you, I'll give you your money back. Just send me an email and you get that money back, the $97. But it's a great way for you to get started, and this is stuff I've been doing for quite a long time, so I think it'll be easy for you to follow. And here's what we're covering in the course. In the course, I cover my 4 favorite non-directional weekly option strategies just for the earnings release type trade setups. These are all defined risk strategies, non-directional, so all we want to do is price to go up big or down big, or kind of a volatility collapse type trade setup. I've got a really cool trade setup called my Grand Slam strategy. It's an unlimited upside type of strategy with defined risk. And then each strategy is explained in really great detail. The course is over 3 hours with a very extensive manual or PowerPoint to tell you step by step what you need to do for these type of trades. And then I go through how to select and construct the best non-directional weekly option strategy based on that stock's pre-earnings projected move. This is a big part of it right here. And then how to calculate that implied projected move. If you're not familiar with it, I go through in detail what it is, how to use it, and then how to use it for your trade setups. And then how to set your price targets using that implied move, and then how to trade the implied projected move, into the earnings announcement. And then we go through how and when to put the trades on and how to manage that trade. And then which strikes, work best. Should you go far out of the money or go close in? So it's a lot of great information. It's a super good price point. And, if you've never even traded options, it's a really great way that you can get started to learn about options. Plus, these are strategies that you can start using so you don't have to sit on the sideline. Now you're also going to get within this course, I've got what I call a trade library. It'll have 32 trade examples of these earnings type trades based on this one specific non-directional option strategy. So, Apple, Google, all these different trades. So these will be in there to show you how the trades work just from examples. I'm kind of a visual learner, so I teach it that way too, to show you trade examples so you can go through at your own time and leisure. So you get all this, everything's recorded, 3 hours, 225-page PowerPoint, and those 2 bonuses, again, for the first 30 that sign up, so we can keep the group small enough so I can answer all your questions. So there you go, and let's see what questions you have here. I've got a few minutes left. question, where can an individual obtain an Excel file that will calculate the probabilities using implied volatility with the values of 1, 2, 3 standard deviations? Well, in this course, I give you my resources for all my statistics that I use, and then I teach you in this course, how to calculate that implied move. So it's all within this course. That's where you can find it if you're interested there. So again, yeah, just put in powercycletrading.com/new, and you'll get all that information you just asked about in this course. Oh, thanks, Michelle, just signed up. And, I've got orders coming in. Again, the first 30, I like to keep these things into a small group so I can answer questions. And we'll send out an email on that Q&A, live Q&A, in about 2 to 3 weeks. But the first one you'll get as soon as you sign up, as soon as you get access, you'll get that recorded 90-minute session that we did last week, and that was using this Iron Condor strategy. Yeah, so this will be a really good program for you, Michael. If you're learning for more kind of experience type of training, this will really help you out. Yeah, so this course, today we did the Iron Condor on Netflix, and we did that based on a 5% move, and today it moved after earnings release 20%. So that, locked in, unless something crazy happens, that's a winning trade. So just made 25% on that. We'll see where it is on Friday at expiration, but it looks pretty good right now. Yeah, so I started doing these type of trades about 3 years ago, and I just got tired of sitting on my hands during an earnings season and had to figure out, okay, well, how can I take advantage of high volatility? And I came up with 4 different strategies that I like to use, and I've been using them and teaching them, and they're really great to use. So it's a very step-by-step detailed course on how to use this trading strategies. Yeah, here's that link again. So the great thing too is that it's $97, so you can get started, and you're not for this kind of course. On my website, if you come back at another time and want to sign up after the fact, it's $197 on my site. So you can go to powercycletrading.com and check out all my courses. I've got a lot of option-related courses and trading courses, and this specific one is on the site right now for $197, and that's without these bonuses as well. Okay, well, any other specific questions? If not, I just would like to say again, thanks, Reed, for having me here today. And good luck with everybody on their trading tomorrow and through the earnings season. So I hope you'll take advantage of my offer and learn how to use earnings seasonality or earnings trades to get you involved and make some really consistent profits on things that are non-directional. So you don't care if it goes up or down. This will teach you how to use those strategies where you don't have to pick direction. All right, thanks again, guys.